welcome to New Road Capital's video series. Like many of you watching, we are also working from home, so the next few videos might look a little bit different than usual. Today we are joined by Louise, who's going to be chatting to us a little bit more about equity. So Louise, to start us off, could you tell us some of the advantages of investing in equity?
Yeah, Sarah. So, one of the main benefits of investing in equity, is the possibility to increase the value of the initial investment amount. And that comes in the form of capital gains and also dividends. So firstly, I'm going to start with dividends. So dividends, when companies often pay out, a portion of their profits each year, to their shareholders, in the form of dividends. And then also dividends are typically, declared by the board of directors, and they do vary according to the company's performance, at a given time. And then also, secondly, capital gains. So equity investors purchase shares of a company, with expectation that they'll rise in value in the form of capital gains. So if you decide to sell the share, you can potentially make a profit. And that is down, to the difference between, the buying and selling price, of that share.
Okay, and then you often hear people talking about common shares and ordinary shares. Are these the same thing, or is there a difference between them?
Yeah, Sarah. So it is the same thing. So ordinary or common shares, is the main type of equity security that is issued by companies. And then just ordinary shares, it gives you full voting rights at annual general meetings of a company. You do receive dividends, should the company pay out dividends. And then lastly, ordinary shareholders have the ability to elect the board of directors of a company as well.
Okay, and then if I were to own an ordinary share and that business went out of business, would I be first in line to be paid out, or where in priority would I fall?
No, Sarah. So you won't be first to get paid out. So when a company is being liquidated, or it goes out of business, assets are distributed following a priority of claims, also referred to as a seniority ranking. And in this, debt investors have a higher claim on the company assets than equity investors. So after the after the claims of the debt holders has been satisfied, when you moved into the equity space, in that case, the preferred stock investors or preferred stock shareholders will be next in line. And then only after that, the common shareholders will be in line to receive the distribution of the assets.
Well, thank you very much for giving us those insights into equity, Louise. And make sure to join us next week, where we will be going through another asset class overview.